Alrighty, so we're gonna go back to talking in regards to life insurance and annuities, as well as like the nature of insurance. So we'll continue and finish this. Hello guys on Instagram. Sorry guys, I'm broadcasting my whole study for life insurance and annuity on YouTube, so therefore you guys can actually stay tuned and listen to everything, and you could also go to my YouTube channel and actually learn about life insurance and annuity. So where were we? We'll go back to where we literally were talking about the nature of insurance. Now we're in risk transference. This was a 36 page like lecture. I'm finally in page 33, and this is why I decided to share it with my Instagrammers, my followers, so you guys could be able to learn and follow through and be able to, get yourself educated on life and health insurance and RIT. Yeah? All right, now for risk transference, the most effective way to handle risk is to transfer it to so that the loss is absorbed by another party. Insurance is the most common method of transferring risk. Insurance enables an individual or group to transfer risk to an insurance company. True, purchasing insurance will not eliminate the risk of death or illness. It relieves the insured individual or group of the losses these risks brings. Insurance satisfies pretty much both economy and emotional needs. It replaces the uncertainty surrounding risk with the assurance of guarantees, and it transfers the financial consequences of death, illness, or disability to the insurer. Hey, Chopper, how are you? However, sharing the meaning of that, each party assumes a portion of the risk, receiving benefits under the system. Elements of insurable risks. Insurables may be one of the most effective ways to handle risk, but not all risks are insurable. As noted earlier, insurers will insure only like peer risk or those that involve only the chances of loss. However, not all peer risks are insurable. Certain characteristics or elements must be evident before a peer risk can be insured. These include the following. I'll give you guys examples, okay? The loss must be due to a chance. In order to be insurable, a risk must involve the chance of loss that is unforeseen and outside of the insured pretty much control. The loss must be defined and measurable. An insurable risk must involve a loss that is defined, pretty much definite or defined as a cost, such as like a time, a place, and an amount. An insurer must be able to determine how much the benefit will be and when it becomes payable. The loss must be predictable. An insurable risk must be one of the in which an occurrence can be satisfactorily pretty much like it is. Okay, so pretty much the way this works is the loss can be predicted, but however the insurable risk must be one of which is occurring be statistically predictable. This enables insurers to estimate the average frequency and severity of future losses and set appropriate premiums such as death, illness, or disability, or all events in which the rates of the occurrence can be protected based on statistics. Sorry guys, I feel like it is freezing in here. It is pouring rain outside, pouring rain. Okay, I feel like I'm super cold. I'm having allergies or whatsoever. However, this is a 36 page essay, so I managed to make it to page 33. And now I'm losing my voice, but I'm completely fine with it, because I have been speaking for 33 prior pages. So let's finish this. There's only 2 more pages, so I'm just gonna finish this and change my whole mood. All right, awesome. Let's do this. Okay, so the loss cannot be catastrophic. Insurers typically will not insure a risk that will expose them catastrophically. There must be limits that insurers can be reasonably certain their losses will not exceed. This is why an insurer would not issue a policy for $1 trillion to a single life. that one death would create a catastrophic loss for the company. The loss exposure to be insured must be large. An insurer must be able to predict losses based on the law of large numbers. Consequently, there must be a sufficiently large pool of to be insured, and those in the pool, the exposures must be grouped into classes with similar risks. Individuals, for example, a group or accordingly to age, health, sex, or occupation, or even other classifications. The loss exposure to be insured must be randomly selected. In addition, the group of the insured must be randomly selected. Insurers must have a fair proportion of good risk and poor risk. A large proportion of poor risk would financially threaten the insurance company because there will be many claims and insufficient premiums to offset the cost of claims. Therefore, keep in mind there is a tendency, it's called adverse selection. Bear with me just a moment. Ashton, what happened? What? What happened? Oh, okay, save it for mommy. Mommy gotta hang up, baby. I'm gonna call. I'm live. I'm live. Thank you, my son. Sorry, guys. So I have to pick up when my son calls, and since I'm using all three of my devices, I have no choice but to pick up. Sorry for that interruption. However, you guys can watch my live on YouTube because I'm definitely sharing my knowledge, and that's something that I felt like was definitely needed, is to learn about life and health insurance and on annuities. However, the loss exposure to be insured must be randomly selected. In addition to a good group of the insured must be randomly selected. Insurers must have a fair proportion of good risk and poor risk. A large proportion of poor risk would financially threaten the insurance company. And main reason why they can't go ahead and just cover a small company and give you $1 trillion. And that would just be catastrophic for us. And the nature of insurance, pretty much to fully appreciate the purpose and function of insurance, it is important to understand that its roots lies in economics and in the concept of the human life value. It has long been recognized that individuals have an economic value that can be measured in part of their future earnings potential. This earning potential is the sum of the one's net future earnings, more precisely, the dollar value of an individual future earning capability. The true significance of each of us, our value, our human life value. This earning potential extends beyond the individual to those who depend on the individual for their financial security. Thus, by definition, human life value is the value today of one individual future earning that are devoted to the individual dependents. And the abstract human life value is the means by which homes are purchased, college education provided, or monthly bills paid. In short, it is the essence of an individual's or family's economic existence. Yet, this value is subject to loss through death, retirement, disability, or poor health. Any one of these perils affects earning capacity and consequently diminishes human life value. It is for this purpose to conserve and protect. Thank you, Romy. And protect human life values that life and health insurance exists. It's just to be able to protect and maintain us. That's really just it. As far as it goes, the basic principles of life insurance, the type of insurance, like commercial insurance, like multi-line insurance, stock companies. We learned about mutual companies. We've also learned about the participating and non-participating makes ensure strong assessment of mutual companies, a pure assessment mutual companies, an advanced premium assessment company, fraternal and risk retention groups, service providers. We've also learned about reinsurers, captive reinsurers, home service reinsurers, government insurance, Social Security, Medicare, Medicaid, SGLI, VGLI. We've learned almost about everything. The TRICARE, the self-insurance, the Lloyd's of London's, which is actually an actual law, the law large of numbers, distribution system, the career, agency system, the personal producing general agencies. We pretty much touch bases and on almost everything, the independent agency systems and so forth and so on, like the managerial system, as well as the mass marketing, another way to sell insurance and through mass marketing method, direct selling or direct mail in a mass marketing method, where agents are really not used instead of policies or marketed and sold through television or radio advertisement. Print sources found in newspapers and magazines, by mail, inventing machines, and over the internet. Dope, isn't it? As far as it goes, the industry oversight and the regulation, the insurance industry is primarily regulated on one state's base, by the one state's like basis is with the minimal federal oversight. The primary purpose of this regulation is to promote public welfare and provide consumer protection and ensure fair trade practices, contracts, and prices. Key is historical events that have shaped and current regulation includes the 1869 Paul versus Virginia. We spoke about that. We spoke about the 1905, the Armstrong Investigation Act, the 1944 United States versus the Southeastern Underwriters Association, as well as the 1945, the McCarran-Ferguson Act. We've also spoke about the 1970 Fair Credit Reporting Act, the 1999 Graham-Leach-Rayleigh, the 2001 USA Patriot Act, as well as the 2003 National Do Not Call Registry, the 2010 Patient Protection and Affordable Act, National Association and Insurance Commissioner, the NAIC. For those of you guys that don't know what that stands for, the NAIC is the National Association of Insurance. It's an organization composed of insurance commissioners from all 50 states of the District of Columbia to the 4 of the U.S. territories. They are responsible for the recommending appropriate laws and regulation. They are responsible for the creation of the Advertising Code and the Unfair Trade Practice Act and the Medicare Supplements Insurance and Minimum Standard Model Act. The NAIC has 4 board objectives. That part. To encourage uniformity and states' insurance laws and regulation, as we spoke before, to assess in the administration of those laws and regulation by promoting efficiency, to protect the interests of the policy owners and the consumers, to preserve state regulation and the insurance of the businesses, advertising codes as existed. Like, hey, how are you? Again, guys, so I'm going to go ahead and thank you guys for actually joining my channel on YouTube. For any additional questions or comments, like, go ahead and drop it below. I'm going to go ahead and switch over to Instagram and give them a little bit of my knowledge. I just wanted to finish this 36 pages. That was 36 pages of torture. So I'm literally just done now. So now we could close out my YouTube channel. I hope you guys love this, and every day I'm going to give you guys a little bit more about like the basic principles of life insurance and annuities. So therefore, like, when I pass my state test next week, you guys can all come to me. Hey, so however, follow me on IG at Lolo La Mulata, LOLOLAMULATA, and also follow me on YouTube at Lolo the Baby, LOLODABABEE. Yeah, I had to think about it for a second. However, guys, thank you so much for watching my channel. I'll see you guys tomorrow. Yay!